everyone, and welcome to the webinar. Thank you so much for joining us. This session is titled Analyzing Schedule E Rental Income. My name is Chelsea Thornton. I'm a training coordinator for Plaza Home Mortgage. The information being presented is provided by Radian Mortgage Insurance. Our presenter is Richard Lauro, Western Regional Training Manager with Radian. Richard has been in the mortgage banking industry for 20 years and has held a variety of positions: processor, closer, underwriter, and loan officer. His focus for the past 10 years has been on training, and with such a rich industry experience, he's an extremely versatile trainer. And with that, I'll hand things over to you, Richard.
Thank you, Chelsea. So welcome everybody to today's webinar on reviewing Schedule E rental income. Just a quick fact about me: I may be Radian's Western Regional Training Manager, but I'm sure you're picking up on an East Coast accent. I started in the mortgage industry back in Rhode Island, so that's where my accent is from. But I've been out west for a long time, but my accent's not going anywhere. And in fact, this year is my 10-year anniversary with Radian, so I will have been at Radian for 10 whole years later this month. Today's webinar, I'm going to be talking to you about Schedule E rental income. And the session's based on some changes and recommendations that Fannie Mae actually made, and I would say seems so far ago, back in 2014 in the last quarter of the year. Fannie Mae introduced some income worksheets, the forms 1037, 1038, and 1039 that we'll be reviewing. So in your handout, and when you did download that, hopefully you printed it out, there are blank copies of the forms. And those forms are going to be the basis of our discussion today, along with Schedule E tax form from the 1040s. And then again, we'll also talk about another form, the 1039, which has to do with rental properties that are held completely by a business. But I do want to point out, because we have many different people from many different parts of the country, and some of you may be some of the wholesale brokers that work at Plaza. So just be sure that if your company or your policy or your investor uses a different format, spreadsheet, or something else that I'm not going to be covering, continue to use what your company or your investor would like you to use. But today's sessions, I'm going to be covering, I call it plain vanilla Fannie Mae guidelines in the use of their recommended forms. Now, it doesn't mean you have to use them, but once we get started and you see some of the forms, you're going to say, well, that looks just like the one that I use internally, and I'll give you a hint as to why that may have happened. So let's get started. And first I want to go over my objectives, and what I'm going to be doing is doing a basic review with the logic reviewing tax returns for income when it comes to rental income. And then also I'm going to review the Fannie Mae worksheets, the 1037, 1038, and that 1039 form. We're also going to be reviewing some frequently asked questions and things that I get regarding self-employed income as it relates to, I'll call it Schedule E. And again, as stated, that on the right-hand side of your screen in the Go-To Webinar toolbox, you see a copy of the handout. So if you didn't get that, please download it, because that's where you'll find the blank copies of those forms. So let's get started, and let's start talking about some simple guidelines. And this is in all of our classes, especially in our self-employed class. We talk about looking at tax returns, and typically you need 2 years of tax returns with all the schedules for someone who's self-employed. And one of the tests that we do for income when we're looking at tax returns is we want to see that it's regular and recurring. If the income cannot be documented as both regular and recurring, it's typically not going to be used for qualifying purposes, but rather as a compensating factor. Now, the income must be both the R and R test, not just one of them, but both of them. So again, you're going to hear me say throughout the sessions, it's important to know and follow your own company's guidelines or investor guidelines as it refers to, I'm only referring to, I should say, plain vanilla Fannie Mae guidelines. Now, we frequently get questions on what analysis method is the correct or the best one that should be used regarding rental income. Now, there are several acceptable methods to determine a borrower's rental income, but again, today we're going to be following along with the worksheets that Fannie Mae introduced in the fourth quarter of 2014, the forms 1037, 1038, and 1039. And again, however, if you use a different form, you don't have to. Fannie Mae says you may use their forms, but you also may use your own. Again, the forms are in the attachment that you received, so hopefully you have some out to the side. Now, rental income is an acceptable source of income if it's stable income that can be established that the income is likely to continue. So again, sounds familiar. So if the rental income is derived from the subject property, the property must be either A, a 2 to 4 unit principal residence property in which the borrower occupies one of the units, or a 1 to 4 unit investment property to use the income. If the income is derived from a property that is not the subject property, there are no restrictions on the property type. For example, rental income from a commercial property owned by the borrower is acceptable if the income otherwise meets all of the other standard requirements when it comes to rental income. Now, this is a little excerpt that comes from Fannie Mae, I will say, referring to their selling guide, and it's in B3-31-08 for additional details as to what Fannie Mae will use as acceptable sources of rental income. Now, this is a snapshot of page 1 of someone's personal 1040s. If you notice that line 17 is circled in red, or boxed out in red and outlined. Now, line 17 is where it would indicate if there's any Schedule E rental income. Now, keep in mind, there's also royalties, partnership, and S-Corp and trust money that could also be on this line. So you actually have to look at the Schedule E to determine if they truly do have rental income. But this is your indicator. If there's something on that line, and as I always say in our self-employed class, one of the best ways to figure out if you're missing anything from a customer, if they give you the first 2 pages of their tax returns and you're wondering, well, what other attachments do I need? If there's a figure on a line, like on line 17, if you notice over to the left, it says attached Schedule E. So that's kind of letting you know, hey, I need an attachment. So you need that Schedule E. So then we're going to look at the Schedule E. Now we have a sample of page 1 of the Schedule E. On the first page, if you notice and you see that there's rental income reflected on there, then you know that the borrower is receiving rent money, which correlates going back to, again, that line 17. Now, on here, what we're looking at, and I have some boxes or lines of squared away in a box and some with arrows next to them. So I have a sample of the Schedule E, and we're going to look at rental income on line number 3. Then we're going to look at and analyze their expenses. So you're going to review and look at 5 through 19 is where all of their expenses are located. Line 20 is someone's total expenses that they had on their rental property. So all their money, all of the expenses that they reduced their income by for their rental property. So on the tax returns, we're looking for, you want to make sure that all the rental properties that are on the tax returns are also accounted for on the real estate owned section of your application, or the 1003, and vice versa. Because, you know, if the properties are still owned by the borrower, they should also be on the application. Remember, consistency is the key when we look at information. Now, I'm going to skip ahead a minute, and I'm going to show you Fannie Mae's Form 1037 and the 1038. And again, we're going to be using the Schedule E to help complete the rental income worksheets in a moment. But it's, again, I recommend that you kind of keep the sheets out next to, I'll say, the Schedule E. It makes it kind of easy to figure out where everything goes. So this first form, this Form 1037, and again, that was in your download on the right-hand side of the screen in the handout section. If you look at the Form 1037, you can see that at the top, it says it's for principal residence or 2 to 4 unit properties. So when you notice the box at the top, it indicates the documentation that's required. So it tells you that you need a Schedule E or a lease agreement or Fannie Mae Form 1025. So that's the documentation that tells you right on here what's required. So then when you go move a little bit further on there, it goes through different steps. and it'll start off with a step number 1. So once you determine what documentation you have, then we're going to move on to the next step. So step number 1 says when using Schedule E to determine the number of months the property was in service, divide the fair rental days by 30. So if you look at the Schedule E, again, I am going to back up a slide a second just to show you to the previous slide. There are fair rental days that are on the Schedule E. It's right above my little box that I have, right where that A is. If you look over diagonally to the right, you can see where it says fair rental days. On your blank copy, it's a lot easier to see. So you're going to look at the fair rental days, and you'll divide by 30, and that will tell you how many months the property was in service. Then we're going to move on to the next step. So let me pull that up again. So step number 1 is we're going to put our results in for how many months the property was in service. And then we're going to start to work through step number 2. So step number 2, and this is going to be very helpful for you if you have your Schedule E for the rental income out next to you. And we're going to start to complete this. So when we go through this on A1 on the Fannie Mae form, you're going to enter line 3 from the Schedule E. That's their total rental income. So we start off with their total income that they receive. Then you're going to subtract out their total expenses. The total expenses were found on line number 20 on the Schedule E. Then the next step, we're going to add their insurance, mortgage interest, and their taxes. And the reason why we're adding this back in is that we don't want to double dip against the customer. You already hit them for this as a debt, so you're going to add back in the insurance, which is going to be on line 9 of Schedule E. You're going to add back the mortgage interest, which is on line 12 of Schedule E. And then you're going to add line 16 of the Schedule E, which was the taxes. And those are going to go in the order. You're going to go in from A, 3, 4, and 5. So one of the things I do want to point out to you is towards the end of our webinar, I'm going to show you where you can find Radians' self-employed calculator. It also has a tab on it that our underwriters created for doing rental income. So I know many times people try to write the lines, numbers, and everything in there, but it will be done for you in our webinar, on our online tool. The next thing, the next step on here is line A6 on the Fannie Mae form tells you that if there was a HOA, you're going to add that back in. So again, back to not double dipping. You hit a borrower for their homeowners association as part of their debt. You don't want to, leave this out of their income too. So you would add back any HOA expenses. So the next step on line A7, it says add any depreciation back. So remember, we're adding back depreciation because that's a non-cash expense. It's something the IRS lets them reduce their taxable income by the depreciation on that property. So you're able to add that back in. You'd find it on their tax returns on line 18, and you would add that on line A7 on here. Now, depreciation, I will tell you, is the reason why Fannie Mae came out with these forms. Because I don't know if any of you have been in the mortgage industry for a while, but if you remember a while back, the IRS moved the word depreciation on tax returns. And when they moved it from a place where we didn't need to do anything with it to a place where we needed to add it back in. Well, Fannie Mae was slow to respond and did not update any forms or any calculations to calculate rental income, and it wasn't there to add it back in. So many lenders created their own, I call it Excel calculators or something that looks very similar to what's in front of you right now. So Fannie Mae did create these forms back in 2014, but they were just, I would say, a little late to the party. But the real trigger to have them made was really this depreciation not being on the original form to add it back in. So now it's here, so you can't cheat your customers out of any income. And then the next step is on A8, it says to add back any one-time expense, amortization, or a one-time casualty loss. And you would find those on line 19 on Schedule E. And you'd have to review the details of line 19, because line 19, there's probably going to be an attachment that goes with it. So what are we saying? We say any one, when we talk about amortization or casualty loss or one-time, I'll call it non-recurring expense, extraordinary expense, I want you to think about this. In the question box, can someone tell me something that you don't do that often on a rental property, that you don't change? An expense that you might have that might be every so many years that you don't need to change it that often. Yeah, new roof. We got some repairs, major repairs, I'll say, or we'll say that you may also see, besides the roof, a water heater might be something that you don't change that often. So the reason why we're doing that is that's a one-time expense that the borrower doesn't receive every year. So think of water heater, new boiler, new central air conditioning unit, things that you normally would not do that often. That one-time expense, the mortgage industry will let you add that back into their income because it doesn't happen all the time. Amortization. I would say some of these things that you typed in there, you may actually see, they actually may fall in the category as amortization. Now, I don't work for the IRS and I'm not an accountant, but sometimes instead of saying to someone who replaced a roof on a home, the IRS may make them amortize that expense over a number of years, thus reducing the amount that they can reduce their taxable income. So let's say you spent $30,000 on a new roof and the IRS says, no, don't reduce your taxable income by that $30,000 because me, the IRS, I won't be able to collect as many taxes from you. So instead, they will make you amortize that $30,000 over a number of years and reduce your taxable income by a smaller increment. Now, that is the reason why the mortgage industry will let you add that back into their income, because the amortization is really an expense they didn't have this year. So they really didn't have that expense this year. So you will, sorry, just read another question that was there earlier from the question box. Got a little distracted. So you'll be able to add that back into their income. The last thing that's in this section is the casualty loss. So casualty loss is, think of water damage, wind damage, fire damage, and the borrower had no insurance on that property for that. The IRS will let them reduce their taxable income by that. And then the mortgage industry, again, that's a one-time extraordinary expense, so you'll be able to add that back into their income. So that is your amortization, casualty loss, one-time expense. So then you're going to get their total of their expenses. You're going to look at lines A1 through A8, and that will give you your total that you will come. So you do a total, and then you're going to divide it by the number of months the property was in service. Again, back up to step one. The result is going to be your qualifying rental income or loss. Now, step 2B on the form, the next section of the Fannie Mae Form. So section 2B of the 1037 refers to only use this method when the transaction is a purchase or the property was acquired subsequent to the most recent tax filing, or the lender agrees to use the lease agreement and or the Fannie Mae Form 1025, which is a rent comparable schedule. Now, normally we don't typically use this. Again, I used to call this a vacancy factor by multiplying that by that 0.75. But if you did, you would use either, again, the results of 2A or 2B and then add the monthly qualifying rental income to the borrower's qualifying money. When you obtain the full PITI as the borrower's primary housing expense, remember that included principal, interest, taxes, and insurance. So that's the key. We're not double dipping against the borrower while you added back the insurance, the mortgage interest, and the taxes. Now, with this form, I have a question for you. So can you have multiple 1037 forms filled out in a loan file? I want you to answer for me in the question box, yes or no, if you can have multiple of these forms filled out in a loan file. And the answer is actually no. And I want you to think about this. The reason why it's a no is that, remember, this is a principal residence, 2 to 4 unit property. So remember, how many principal residences can you have? Only one. So this form, just to keep in mind, if you are going to use it, this is going to be used when the borrower, it's their primary residence. Remember, they live in it, and then they also are receiving some rental income from it. So that's when you're going to use this form. The next form is the 1038, which we'll be talking about next. In the 1038 form, 1037 form is going to be the one, I hate forms and I hate numbers. It's going to be the 1038 form is going to be the individual rental property or investment property, to say, for lack of a better term. And that one you can have multiple ones of. So again, I'm going to reference back to Schedule E again because we're going to look at these same exact lines. Now, I always say that rental income isn't that difficult. I know Fannie Mae has 3 different forms, but if you know how to fill out and complete one, I would say the others are just as simple, especially with this investment property. It's just like the other one. We're going to, again, look at total rents received, which is line number 3. And then you're going to look at line number 20, which is their total expenses that they have. That gets subtracted out. And then if you notice, my arrows are basically at the same things that we're going to be using to add back in. So let's take a look at the Form 1038. So it's better for me to read it just off the slide than try to remember these form numbers. So when we're looking at this here, again, the same thing that we had in the other one, right up at the top, we have our steps, and it tells you what documentation that you need. So it's going to tell you, again, Schedule E or lease agreements. And then you're going to go and calculate the numbers of months, and that's step 1. You're going to look at the number of days the property was in service and then divide the fair rental days by 30, and that will give you how many months of service that the property was in. So a quick thing for you. On those months of service and the property being rented out, so if it's blank, I just want to point out blank means 365 days to the IRS. So if you do see that the number of days of fair rental days is blank, blank does mean a full year to the IRS. One of the things I like to talk about in this class, and then I know it's not a fraud class, but everyone always wants to say that their investment property miraculously became their primary residence just on time to refi. If they moved in that property and they say they moved in it last year, they shouldn't have 365 fair rental days, or it shouldn't be blank for rental days with the IRS, because again, that also means 365. So just keep that in mind that, if someone really moved in a property last year, when you do look at their tax returns, the tax returns should go along with the story and show that it wasn't rented for a full year. So again, step 1, same as before. Now then we're going to move on to our step 2. And this time when we go through A1 through A10, now I'm going to be referring again the same lines as we did before. So we're going to start off with line number 3, and that's going to be their total rent. And then we're going to look at their expenses. That expense total is going to be on line number 20. So it's going to go on the total expense line is A2 on the 1038. And then when we get to your A3, 4, 5, and 6 is going to be the same lines again that we looked at the Schedule E. You want to make sure that you add back the mortgage interest. You want to add back the taxes, the insurance, the mortgage interest, and then the taxes. So lines 9, 12, and 16. And then again, also if this was an HOA on A6, if you hit them for that as the debt, you also have the HOA due. And now, then it's going to say, the next one, the add back any one-time extraordinary expense. So again, think of the nature of the expense. So amortization, casualty loss, and so forth. So another question for you, just to make sure you guys are paying attention to me. Who can tell me what a casualty loss is? Give me an example of a casualty loss. on a rental property? Type it in the question box. Yeah, the property got flooded, roof damage, flooding, fire, burglary, burns down, hopefully not to the ground. So, and again, the key is without insurance, because without the insurance, the IRS will let them reduce their taxable income by this. And if you think about that, it makes sense, because if you had insurance and you lost money, then you could actually add it back in. And plumbing problems, I'm going to put that with cold, and they froze their pipes and their pipes bursted and they had no insurance. So there you go. Now you have your money that you can add back in because they had insurance. Now, someone asked about Airbnb rental income. Thank you for asking that question, because for the longest time that stumped me all the time, and I was like, oh my God, how do we calculate Airbnb? You know those fair rental days that we did at the very beginning? Those fair rental days will tell you how many days that property was rented. So you don't have to go and give yourself analysis paralysis with an Airbnb. It's going to tell you, and then you're going to calculate. Remember, you calculate the months that the property was in service. So remember, you're going to get their fair rental days, and if those were all Airbnb days, then that's what they're putting there for a total, and then you divide that by 30, and that basically will tell you how many months of service they've been in. So hopefully that makes sense. Does it need to be rented or available to rent? Well, you actually have to be receiving the money. So I'm going to say rented, because if you're not receiving the money, you're not going to be you're not going to be able to claim anything on your tax return. So remember, they have to show a history of receiving this. Now, the Airbnb does fall into a little bit tougher category, because if the borrower just started doing this, and they've only been doing it for a year, your underwriter may ask, and again, there's nothing in guidelines that say this, but they may ask for a second year to show that they've been doing that for at least 2 years. So someone asked another question. So you need to know the borrower's current mortgage PITI payment to figure out the rental income in box 10. Correct. You would need to know what their borrower's full PITI payment is to calculate it. You would subtract out, well, the proposed PITI for the property. That is correct. So the form is very similar. Oh, someone asked another question. When you have a casualty loss, won't that mean the property was not rented for the full year? Not necessarily. It just depends on the nature of the casualty loss. The casualty loss could be the new appliances that you ended up putting in the property. The casualty loss, just think about it. I would just say that if it wasn't rented, that might be an explanation for a low rental income for 1 year over the next year. So I would say that whatever the borrower tells you in the application is, like I always say, is their story. As we receive documents that come in, if the borrower told you, oh, I have low rent last year because I had flood damage and my property wasn't able to be rented, that would totally make sense with the story that they're telling you. Someone asked a question, what line is it on their Schedule E? So hopefully you guys kept a copy of the Schedule E out to the side. So the casualty loss is going to be located on line 19. It says other, and it will be explained. So it's not going to be on line, it's going to be line 19 on the Schedule E. You use the proposed payment on here. The question, I always say that if you look at the form, it's pretty much self-explanatory. For the subject property, you're going to use the proposed or existing PITI if it's the non-subject property. And someone asked another question, to give credit for rental property. So will the forms be updated or guidelines updated since mortgage insurance is no longer deduction on 2017 tax filings? Well, David, that's a great question, but that's got typically nothing to do with these investment properties, because typically on investment properties, you usually don't have mortgage insurance on them. Principal residence. So primary residence, if it's not here, mortgage insurance is not one of these things that you're adding back in. It's not a deduction of rental income. So don't have to worry about it at all. So MI is not part of the deal when it comes to rental income. It's never been a deduction. It's only been for a primary residence that you can deduct it on your tax returns, and that goes on a different form. So, and I am, again, not a tax expert. I'm not 100% sure that it's not deductible in 2017. I would consult with your accountant before you do your own taxes, just in case anyone was thinking about that. But I'm going to move my question box over to the side again, and I'm going to cover a couple more things, and I'll scroll back to see if I missed any questions. But let's move on. I want to talk about our next form that we want to get into. I'm filling out the Form 1038. Now, the 1038 bottom half of it, or completing the 1038, again, Step 2B would be if you're able to use lease agreements. Again, most lenders don't use these. Again, it would only be if the property was acquired subsequent to the tax filing and you don't have any information. But let's talk about this 8825 form. So I always say that if you look at this 8825 form, if you covered it up with your hand, if you covered the top portion of it, it looks just like a Schedule E, except it's not. Now, the difference with this tax form is this tax form is going to be used when your borrower doesn't personally own a rental property, but the rental property is actually owned by the business, a partnership or an S-Corp. If the rental property is owned by the business, a partnership or S-Corp, and you're analyzing the 8825 to calculate their income, I just want to point out you would not be using the rent money on the K1 because you can't use the money twice. You can't use it from the K1 and complete this analyzation of this form. So if you're analyzing this form, you would get the 8825, and this is that last form from Fannie Mae. It's going to be that Form 1039. So the 1039 form is going to be used in conjunction when the business owns the rental property. So again, the business owns the rental property. So let's take a look at that. Let's take a look at the form. So the Fannie Mae Form 1039, again, this one here, it's going to be the lines that we pointed out on the last slide. We'll show you what lines you need to add back into their income and what lines you need to subtract out. It's just like the other form where you start off with their gross rent. You subtract out their total expenses on line A2. You're able to add back insurance, mortgage interest, and add back the taxes. And then again, if there was an HOA, you would add back the HOA dues, any depreciation, and then again, those one-time extraordinary expenses. So I always say, like I said earlier at the beginning, a lot of this is repetitive. So if you do know how to do one type of rental income, whether it's the principal residence, the investment property, or the property that's owned by the business, all the forms are pretty much, I would say, pretty easy to follow along with. If you do have a tough time with doing rental income and filling out these forms, Fannie Mae's are PDF files that you can download from their website. Radian does offer a self-employed calculator on our website. If you go to radian.biz, you hover over lenders, and it says self-employed income analysis. I know you're all thinking this isn't a self-employed class, but on our self-employed calculator, once you download it, so you click on that, you download the self-employed income analysis, and lo and behold, at the bottom of that is where we have our rental calculator. Now, for all of those of you who like cheat sheets that have line numbers next to them, if you notice, on our calculators online, they are basically Fannie Mae's forms put into an electronic format, and they have the line numbers right next to them. So it makes it a little bit easier for you. So I always say, don't give yourself analysis paralysis over rental income. But I got one other tip for you salespeople that are out there. When you ask borrowers for tax returns, even if it's their Schedule E, whenever you're asking for tax returns, borrowers get afraid. Remember, there's a big emotional process when you're purchasing a home, and they're afraid, and they really want to know, like, why do you need my tax returns? Whatever you do, please don't tell them because the underwriter needs them. That's like telling your customer, because my mother told me so. What you want to say to your borrower to alleviate their fears is say that you'll be analyzing their rental income for qualifying income for their mortgage, because there's a big difference between taxable income and qualifying income. And just let them know that's all you're looking for. And you can even alleviate their fears that you don't work for the IRS. You could even tell them they could make a mistake on their tax returns and you would never know. The only way that you would know if there was a mistake is if it impacted their qualifying income for their mortgage. So that's the last thing I wanted to cover with you. I do want to check and see if anyone has any additional questions. Please type them in the question box. I'm saying don't be intimidated by rental income. I don't see anyone else typing any additional questions in here. Oh, I see some coming up. An investor with 2-year history in just do we have access to calculate? Yep, you have access to the calculator with a password. I'm not sure if I know the question where this says investor with 2-year history. I'm not sure, but you don't need a password to access our calculator on our website. Is there any way to watch this session again? Yes, that's a great question. A recording of the session will be sent to you after the webinar has been concluded. Purchase a new investment property, can he use the full rent income on the lease? Oh, not the full rental income. That's that other part where you're going to use 75% or take into account for a vacancy factor. So if they just purchased it and they don't have it on their tax returns, again, that's where the lease agreement and the vacancy factor comes into play, or that, I'll call it step 2B, where you're using lease agreements. Someone's asking a question. The borrower is a 33% owner of a partnership, so that means you're going to get their business returns because they own more than 25. Partnership owns 3 properties. The borrower is not obligated on any of the mortgages. Would you use the Form 1039? Nope, you wouldn't need to fill it out if the properties are listed and they're counted for on the tax returns. Remember I said if the rental income's on the K-1, you could either use their share of their rent that's on the K-1, or you would analyze that 8825 form. So if you're using the income off of the K-1, you don't fill out the Fannie Mae Form 1039. Great question. Won't Airbnb considered more? I'm not sure if the IRS or the mortgage industry considers it more commercial versus residential. So someone buying a new single family, I think it was supposed to be an R, and rent out current condo. I don't know the rest of the question. So, oh yes, rental agreement. You use 75% of the income on the rental property, on the brand new rental. Remember to always check with your investor in your current guidelines, but it would be 75% because again, why is it only 75? And that's take into account for expenses. Another question, do you need additional rental income docs when it's an Airbnb, like from Airbnb? Lisa, I will say I would ask your underwriter. My guess is you definitely need to document everything. My underwriter would always tell me. I'm not 100% sure on the Airbnb. Again, I haven't been in the industry long enough working in it, but and I apologize that you can hear my bird screaming in the background. So sorry about that. I know he likes when I do plaza webinars. Most of the time he's quiet. So I mentioned if a property had a one-time damage, can we use it with insurance or without insurance? So the insurance with and without more has to do with whether or not they can write it off on their tax returns. So if you think about this, if you're the IRS and you lost money, so if, now you say you can't hear me, okay. Must be that crazy bird making noises in the background. I apologize. If your borrower had a flood on his rental property and he did not have insurance, the IRS would let them reduce their taxable income by that loss. That would show up on the tax returns as a deduction. You're able to add that back in because the mortgage industry or guidelines say we don't want to penalize them for something that's only a one-time deal. So you are able to add that back in. They can't write it off if they had insurance, so it wouldn't even be on their tax returns. So great, enjoying. If rental owned for 2 years, if Airbnb rented less than full year, will the underwriter still average over a 2-year period? They won't use a 2-year period. They may use a 12-month, again, barring that they're using it. So if someone only receives income for 1 year, we're not going to divide by 2 years. It would probably be a 1 year. But my more important thing for that question is the underwriter going to use it? Is it going to be acceptable for them? Because they've only had it for 1 year. So you guys are asking a lot of great questions. I will say that I'm not an underwriter. I'm not a scenario desk. It makes it a little tough, but I would say make sure the most important thing is that you consult with your underwriter or your investor, because I always say that after the webinar, you can't say, well, that guy from Radians said I could use it. Plain vanilla Fannie Mae guidelines will tell you that we look for history of receipt and continuance of someone's income. Typically, we're going to look for 6 months to a year of receiving something, and we want to make sure it's going to continue in the future. Border income, that is too scenario-based, Jessica. Remember, plain vanilla conventional loans, I don't want to give an answer, and then someone might have a different loan program that they can work in. Can you add back casualty loss if the property is a primary residence? If it's a rental property and they took that deduction on their tax return, you can add it back in. If it's their primary residence and they don't rent it out, there's no place to reduce your income, I believe, with the IRS. Will you please repeat the answer regarding using the K-1 and not doing the 1038? Okay. You wouldn't fill out both. Someone asked the question, when would I use the K-1? When would I use the 1038? If you're using the K-1 income, on lines 2 and 3 on a K-1 will show rental income. If you use it from there, remember, if that's where you're using it, you're not going to also fill out the Form 1038 based off the IRS Form 8825. You can't use the income twice in both places. Does the new tax legislation affect casualty loss? Great news on that one is that's next year's problem, not this year's problem. Just remember, all of the tax legislation and everything that's passing will impact the mortgage industry income calculations next year, not this year, thank God. We'd be updating a whole lot of stuff. So I don't know for sure, but stay tuned. You'll see updated trainings from, I would say, Radian and everyone else out there regarding rental income and self-employed borrower income as to what impact it will have to what we look at, if there's any impact at all. So again, that's not this year, that's next year.
All right. Well, have a great day. Thank you so much, and we'll talk to you soon.
Thanks. Bye-bye. Have a great day. Bye-bye.